Boom. Right. You guys seen Gone in 60 Seconds with Nick Cage where he's like, let's go. Right? It's kind of how I feel right now. I literally just got back from like 2 hours of football practice. I did not even get a shower. I scarfed some food down and here we go. So living on the edge, right? So tonight, the IUL is Index Universal Life, right? The current sort of crusade. When Primerica was built, it was really like created to be anti whole life, right? So trying to get rid of the cash value whole life industry. Now, obviously, we never were able to do that. It's too big, right? But we have the ability to still keep that crusade alive because every time it just becomes a new thing, right? Cash value, whole life, be your own bank, infinite banking, index universal life. It really doesn't matter. Any product where someone sells a client one thing, well, actually two things, right? An investment and a life insurance policy, is sort of some sort of cash value and a life insurance policy. Anytime there's two things inside one product, they're getting ripped off. And I'll prove it to you. I will show you, right? There is no situation that I've ever seen where a cash value policy, index universal life policy, anything like that, if you get in front of somebody that's relatively young, there's no way it wins, right? And I'll show you why, and I'll go through that with a live demonstration and a real policy that I've cleaned up and call it redacted, right? Remove a lot of personal information. So we're gonna walk through that, and then I'll do what I call like the whiteboard, right? The split side of cash value, and I'll explain that. And then when we're done with that, guys, what I really want you to think about is when I'm done explaining it, would you ever buy that thing? Okay. Would you ever buy that thing? And so a couple of things really quick before we get going on Primerica Online, right? You've got different resources when it comes to IUL stuff. Hey, look at that. Another $1 million earner. Crazy. Crazy, right? Let's see. It keeps moving around. It's been like on the top level here for a while. Um, Wall Wealth, How Money Works, We Do What's Right, Gulf Coast Media, Millionaires. It was sitting here on top level. If not, I'll go find it. If somebody can kind of play around on POL while I'm getting started and just like point to where like all of the IUL stuff is for the training, that would be cool. It's probably over here under like on demand, right? So POL home on demand. There's tons of resources. And if you've never seen this before, this will be good too, right? Like if you're ever looking for like brochures or like these are where we get all the different presentations, right? If you want to go look up, like see if there's an updated one, right? So like Ultimate Kitchen Table, Ultimate Opportunity, the sales presentation, that's the blue page one that we call that, right? Different events, different announcements that are out there. Like if you want to print out a flyer or something, these are the different like brochures, right? And if you just want to, scroll on this, you can click through that. Here's your IUL playbook. This is what I was looking for, right? So winning the conversation, that's available for you. There's different videos that you can go watch, guys. There's so much, and there's presentations that are pre-built for you, right? This is that where's the money presentation. You got to just make sure that whatever presentation you're looking at, right? Like, see how this one says US only, so that's everything like US only, not New York, because there's something in that one that's not offered or available in New York, right? So you just got to pay attention. Some of them are in Spanish, some are in French, some are in Haitian, Creole, right? There's a lot going on. So just make sure that you're grabbing the right one if you're going in here and looking for different stuff. Okay. So just some basic information for you on that one. But let's pull up really quick the IUL policy and we will get this going, right? So this is just one that I have saved that it's a real client. IUL redacted. Here we go. So Index Universal Life. Okay. Like I said, real client. I've already, highlighted a few things and taken some stuff out, but we're gonna go over some key features of like reading this policy so you get practice with that as well. Because it is very powerful, guys, if you are sitting down with someone and you're in their actual policy. You're not making it up, you're just showing them, right? If it's black and white in their policy, can they really argue with you? I mean, put it like be real, put it in the Zoom chat. Can they really argue with you if you're showing them in their policy? Right? Yeah. If it's structured right, I know, Matt. I know. Yeah, they can't, right? Because it's in black and white. So what we're gonna do, I want you to see what's kind of going on here. So this is a little bit older, right? Because this is one of the first ones I ever helped fix, right? It's a $400,000 IUL. The client was 25 when he took it out. He had a preferred plus health rating. So preferred plus for us, if you're a man, would be like class two, right? So standard is class six, right? Preferred plus is class two. Okay. He's paying $110 a month. $110 a month, guys, at 25. That's crazy. Something else to look at, right? You have a surrender value, you have ending net cash surrender value, and then here you go. Every IUL policy, somewhere between page one and page four, has something right here that says, when will my policy lapse? It's regulatory, it's required. Okay. Guaranteed worst case scenario. This is literally the only thing that says guaranteed. This is what is going to happen. If you keep paying for your policy, you took it out in 2022. If you just keep paying your policy at the worst case scenario, it's going to lapse in 2047. So even if we were just looking at this as like a term policy, how long did he have coverage? If he took it out in 2022 and it's gonna, well, he took it out in 2016, right? Because that's when it was opened. He took it out in 2016. So issue date was 11 of 16, right? But then it's gonna lapse in 2047. So it's like having like a 31-year term. I mean, really, right? Because if it's gonna lapse in 2047, that's 31 years. So that's one way to read that. The no further premium means if he stopped paying on the policy, right, it would lapse in 2024. That was based on 2022, right? So that means that it's eating itself, right? A client can stop paying, but now it's going to use the cash value that's built into it to pay the premiums. But then once those are gone, it's gone, right? It's called the policy cannibalizes itself. All right. And then based on current assumptions, it would last him until 2077. Now, let's look at guaranteed and current, right? Because that's also right here in the account. Guaranteed interest rate, 3%. Current interest rate, 3%. So current assumptions, guaranteed. Guaranteed, current. Well, if those are the same, right? I'm no math magician, but 3 equals 3. And if the worst case scenario is right here and they're the same, it's going to lapse in 2047. Can you guys all see that? Put in the Zoom chat so I know you're live, so I know I'm not just like talking to Matt staring at me. Cool. So hey, Mr. Client, can you see that based on these two numbers being the same, that your policy is going to lapse in 2047? That's a question, right? That's you're looking for a yes answer because you want them to admit it. Okay. Here's some other things, right? Because then you'll get some like tabular data, and this can get overwhelming at first if you've never looked at it. So don't get sort of like bogged down in this stuff because what's really important is a table later on where it shows every year of the policy, right? Every year of the policy, and then how much is there in a death benefit, net cash surrender value, meaning if he canceled the policy, how much of the cash would he get back? Well, let's look. Year 7, 8, 9, 10. Okay. Let me see if I can zoom this in just a little bit more for you guys. So you're not, I know Matt's over there. He's got to get his readers out. Right. So look, 7, 8, 9, 10, right? So year 10, how much cash does he have after paying for this policy for 10 years? Goose egg. Does this seem like a good investment? Because that's how these are sold, right? These are sold as you could withdraw money from this. You could borrow against it, right? Okay. And now that's the guaranteed because let's look at the non-guaranteed, right? Which is like the better scenario. At 10 years, he's got a whopping $642 that he could draw from. If he were to cancel the policy and then take the cash out. That's what surrender means, right? In the account value, there's almost 4,700. So that's what he could actually borrow. After 10 years, he could borrow up to $4,700 of his own money. That's insane. That's insane, guys. Right? Now, let's keep fast forwarding, right? Let's keep going. And as we get down here, do you see where the zeros start to happen? Well, I want you to pay attention to this column right here, because what does this column say? It says death benefit, right? Another name for that, guys, is life insurance. Well, if the death benefit goes to zero, how much life insurance does our client have at age 56? Zero. Freaking goose egg. Okay. Also, at that point, right? What's his net cash surrender value if he just says, to hell with it, I'm canceling the policy? So now he's 56. He has no life insurance and no money. Let's go back, right? Does this seem like a good investment? Because here's what they show you, right? Oh, the account value is increasing. Okay. But what's the point of the account value increasing if I no longer have life insurance? I'm getting close to retirement age and my account value was never greater than like 40 grand. Can you retire on 40 grand? No. Does it do you any good? No, right? But here's what they will show you, right? Here's the one that they want you to look at. Because again, let's go back to the non-guaranteed current, right? So the net cash surrender value keeps increasing, but even in this column, in like the best case scenario in this column, what is the max value? Right there. Crazy. 85 grand. 85 grand, right? But wait, there's more. Because as you keep going, right? Remember, our client is still getting older. As you keep going, does the account value keep going up or is it going down? It's going down, right? That's not really what we want either. That's not what we want either, right? So this is where for most people, they're like, oh man, they never showed me this, right? Well, yeah, okay, it's on page like 8, 9, or 10. Here's the scary part. This is on page 1. When will my policy lapse? It's on every IUL, guys. It has to be there. It's on every single one. Okay. So now I'm going to run a quick scenario for you for this client. When he was 25 and he got a preferred plus health rating, I'm going to show you really quick what had he bought term and invested the difference, just a real quick scenario rundown of what he would have had. Okay, or could have had, depending on how you want to look at it. The app's been slow, so like we'll give it some grace. Get that up while we're waiting. Yay! All right, tools, quick quote. Bang. I gotta talk to Bobby Peter. We gotta make this faster. All right, or I'm just very, very impatient. Okay, so non-tobacco, right? He's a dude. He was 25 when he took the policy. Precision term because it's more than 400,000. I'm going to give him a 35-year term. The price is going to be the same for 35 years. He was preferred plus, right? And he had 400,000 in coverage. Guys, that's a whopping $36 a month. Okay. Now, if we were doing the right thing, we probably would have given him a half a million because that's the next banding level. Because for another, what, $3, $4, we're going to give him 100 grand in coverage. That's what makes sense. So that's what we're going to do. So we'll say $41. Okay. How much was my homie paying a month over here? Right there. 110. Okay. Right. Look, I'll even use the calculator so you know I'm not like making stuff up. Right. 110 minus 41. We're going to put in 69 bucks a month. I'm not worried about the change. I'm not worried about the pennies. Okay. 69 bucks a month. He's 25. We're just going to go the length of the term. Okay. 25. 35-year term takes him to 60. We're just going to put in 69 bucks a month. Would you guys agree he would probably be okay with 70? Can we just say 70? 69 is just a weird number, right? So we're going to open it with 70 and we're going to put in 70 bucks a month. And we're going to assume a 9% rate of return because that's the S&P, right? That's the S&P. Actually, you know what? Let's do this. Let's do this. S&P 500 because we can use real data, right? Returns from 20, oop, not 21. We're not going to the future. 2116 to 2026, like to today. Let's just see. All right, strong growth from 2016 to 26, so that 10 years, right? Strong bull run. Uh, so look, there are some downs, right? There are some big ups and also some big downs, right? But if we added all this up and then did an average, almost every single one of these return years is a double-digit return year. The only ones that were down were COVID, right? Like even the COVID year ended up crazy, but more ups than downs, right? So would you guys be okay? Like Matt, you can take a screenshot of that and you can like actually go do the average, but I'm just going to use 9. Is that fair? Is that fair? Okay, good. Good. Here, I'll do this because I actually would love for you to go uh just go run the numbers for me, right? Just like add all that up and then take an average because I would just love to see what that is. I thought it would give me the average rate of return, but maybe we can ask it a better question next time. All right. Bum, bum. Where'd it go? I must have clicked something behind that picture. All right, I'm gonna use 9. Okay. So from 25 to 60, not 57. I don't know why that's like that. 35 years, right? 9% rate of return. 200 grand. Look, he's not gonna fully retire off of 200 grand, but 200 grand in a Roth IRA at the end of his term when his life insurance is up and he's had a half a million in coverage the entire time, right? Look, I don't know what you guys would rather have, but if I had to choose between, forecasted for 200 grand versus at 60, mind you, right? At 60, because we're going to use the same forecast. At 60, hell, even at 59, right? At 59, he's still got a half a million in coverage and close to 200 grand. Not anywhere on here. 16.34. Shoot dang. Now, here, Matt, I'm gonna do this, right? So from 25 to 35, we're gonna use 16%. Okay. So you'd have 21 grand. So now he's got 21 grand, was it 20,822? And now he's gonna go from 35 to 60, and he's gonna go back to 9%. Because I just want to see, right? Because that's a pretty hellacious head start. We just netted him another 70 grand, guys. That bull run for 10 years just made your client an extra 70 grand. That doesn't suck. Crazy, right? That's math. Did I make any of it up? We use real data. That's real math, right? I'd take it. Me too, Kurt. Right? Me too. So, guys, you got to remember anytime that someone is selling something where you're paying for two things, but you ultimately will only ever get one, that's a problem, right? That's a problem. Now, let's switch over to a straight up like cash value life insurance scenario, whole life. Okay. Whole life scenario. I'm not even worried about anybody's age. I just want to explain the process and just some generalities. Okay. And so let me pull up a whiteboard and I'm just going to draw a picture. Just going to draw a picture when it loads, right? So I'm going to draw you a box, right? And the box is going to represent the actual policy. Okay. So please try not to draw on the screen. It makes it really hard for me. My ADD kicks in. I just see like pictures showing up, right? So if you're moving stuff around, that should be okay, right? It shouldn't be a problem. So on one side, guys, you're going to have the actual like death benefit, right? So the actual like insurance. So we'll say life insurance over here. How much coverage should we give the client? 500,000? It's probably my favorite amount of coverage to write, right? Because that's where our conditional coverage cap is, right? We don't go above that when it comes to conditional coverage. And so if that's the life insurance side, then this side has to be the cash. Okay. This is the way every like whole life cash value policy is built. You have two sides. Okay. On average, if you are paying for a cash value policy, the rule of thumb is for men, right? $100, right? Per 100K. That's the easiest way to think about it. Now, somebody could come back healthier, it could be a little bit cheaper, but on average, right? Like if you called somewhere right now as like a 30-year-old dude and got a quote for 500,000 in a whole life policy, it's going to cost you about $500 a month. No, that's non-nicotine, right? That's just standard. Okay. Women probably a little bit cheaper, but about $100 a month or about $100 per 100,000. So if our client has 500,000 in coverage, what's he paying per month, right? What's the monthly premium? 500 a month. And if we were doing the AP on that, how much annual premium would that be? Right? So 500 a month times 12 is 6,000, right? So the annual premium on that policy is 6K. That's what your client would be paying a year for his life insurance. Guys, do you know anybody right now that wants to drop 6 grand a year on life insurance? I don't. I don't, right? So here's what happens, right? For the first 2 years of the policy, there will be no cash inside the policy. Does that seem fair? Let's flip it this way. If this were a savings account, Nicole, and you walked into my bank and you said, "Hey, no, I'd really love to open up a savings account." And I'd say, "Girl, I got the one for you. You're going to give me 12 grand, and in the first 2 years, I'm going to give you 500,000 in life insurance, but no cash." Does that sound like a savings account that you want to open? Sounds like you'd be like, hang on, right? You'd come at me with some kung fu. You'd be like, you ain't taking my money. So when people want a cash value policy and they're going to hand over all this money, but there's no cash inside, does it really feel like they're getting what they want? No. They're being sold this idea of being able to borrow against the policy. Let me ask you a question, guys. Can you borrow something that isn't there? Right? Can you walk over to your neighbor's house and borrow a cup of sugar if they have no sugar? No, you can't borrow what's not there, right? And so I'm going to draw another picture. We're going to think about this like in terms of time, right? So this one is going to be like time and money. Okay. So like age of the client and account value, right? And so we're going to think about this in terms of like two lines. Okay. So boom. So cash on this side, right, is going to start at, right, 0 and go all the way up to 500K, right? That's sort of like the cash value lottery, right? How old, guys, will the client be, right, in terms of age? How old will they be? Oh, I don't know why that stayed connected like that. Get off. Okay. How old will they be when that thing reaches 500K, right? Age. So we'll put age over here, right? 100 years old, right? So let's just say, right, your client over here is 100 and they opened the policy, I don't know, when they were like 30. Let's just say 30, right? So 30 years old. So now they're 30 and then all the way to 100, right? At 32, right? They've been dumping in 6 grand a year, right? Right? Zero cash. at 32. They've still got a half a million in life insurance, right? That death benefit is always there. Right? Now, let's fast forward, I don't know, 20 years, right? Now your client is 50. 20 years down the road, right? You're not going to be at 250,000. You might be at this point maybe like 100K. Okay? So you've got like 100K in this guy and you're 50 years old. Now, right? Logan, let's say you want to get some of this money, right? If you want to get some of this money out of this cash value policy, Logan, do you know what you have to do? And I know you're brand new, so I'm not picking on you, brother, right? But can you just take the money or do you have to borrow it? You have to borrow it, right? You have to take a loan. It's called a policy loan. And on average, Logan, a policy loan is going to be somewhere between 6 and 8% that you have to pay it back. But generally, if you had to take a loan to go do something, do you usually have the money to pay it back right away? I mean, sometimes, right? But here's the problem, right? Because you took a loan. So now you have the cost of the insurance, right? So you have the original 500 bucks a month to keep your policy alive, plus paying back the loan, right? Now you got to pay both, or you're going to go at risk of letting your life insurance policy lapse. Okay, so now you got to pay both just to keep it alive and keep it on track. Okay, but do you guys really want to borrow your own money? The cool phrase is be your own bank. How many banks have you guys ever been to where there's one client? I've never seen a Chase branch with one client. I've never seen a Bank of America or a Truist or a Fifth Third or Wells Fargo with one client. It doesn't exist. Why? Because they want all the clients, because more clients equal more money that they control. If you're your own bank, well, unless you had a major windfall, right? Now, don't get me wrong. There are very, very specific scenarios where you can leverage something like this and it works. But this is not for everyday people. This is not for somebody that just needs some life insurance. God forbid something happens to them so that their family is taken care of. Okay. Because we're going to show you the difference with buy term and invest here in a second. And it's going to be drastically different. Okay. So watch this. Here's the crazy thing. Now, let's say your client never listens to you, Logan, and they just keep rocking, right? Now they're like 75. And I mean, I hate to say it, but that's the average mortality age for men, right? So I got like 30 years left if we're going with averages, right? And then the next 25 years, this thing's probably going to get up close to, I don't know, 300K. I mean, it is 45 years of investment and growing, right? So we'll say about 300K. And at 300K, right? Logan, let's just say this was like I don't know, right? Your rich uncle, right? Your rich uncle died and left you this life insurance policy, right? It's got a grip of cash in it, man. It's got 300K. But would you rather have 300K, Logan, or 500K? Which one do you want, man? Look, dude, you ain't alone. You want more. You ain't alone. But here's what happens, and here's what's gross. Because Logan, we know you're going to take that. When you take that 300, though, who keeps this, Bubba? The bank, the insurance company. So in reality, if you take a look at it, in terms of life insurance, you actually only got a $200,000 life insurance payout because you got your 300K in cash back. Gross. So the longer that someone keeps a cash value policy, the less they're actually getting back in a life insurance death benefit. Because if the company's keeping the cash, well, hell, the company kept 300, they only had to give you 200 of their money, right? And so the longer they keep this policy, guys, the less the company's actually going to pay out. This is the situation where the client's been paying for two things the entire time, and they're only going to get one because they either get the cash or they get the death benefit. That's it. Now, you could find some pretty advanced IUL policies that carry what we call an option B. And in those situations, you pay a higher premium per month for the policy, but you will get both. But you pay for it. You get what you pay for, right? You have to pay a premium to do that. Now, here's what we're going to do. I'm going to go back and we're going to run this scenario again, okay? We're going to say the client's 30, and I'm just going to keep him at standard coverage, right? 30-year-old man, and we're giving him 500,000. Non-tobacco, right? Just regular old dude. But before I get away from this, one thing you should know is that in most whole life policies, somewhere around 60, 65, it really depends on how long the client's been paying for the policy, right? You stop making monthly payments. So stay with me on that, right? Stay with me because that sounds good, right? Oh, you get to keep your life insurance. You don't have to pay for it anymore, right? Sounds good. Stay with me. Just keep that in mind, right? Keep that in mind. So we're actually going to take this one to 65. Okay. We're going to say that the client's coverage is going to go till 65 and he's going to be done paying. Sounds good for them, right? Trust me, I'm still going to win. I only play games where I win, Logan. My kids hate it, right? They hate it, right? They won't play board games with me anymore because they think it's rigged. It's like, no, it's not rigged. I'm just better than you. I've been around longer. No, I'm just playing. All right. So look, client's 30, right? Client's 30. We're going to give him a 35-year term. We're going to give him a standard, right? Standard. Nothing crazy. Standard, right? Nothing special, right? Homie's only going to have to pay 77 bucks a month. Hell, Matt, I'll even throw in a waiver of premium. I'll give it to him. I'll give him waiver of premium. Why not? 83.34. Guys, this is buy term and invest the difference. BTID. Okay. The difference, we would all agree, is $417 or $416.66. Yeah. I'm going to say 417. Is that fair? I don't think the calculator really likes pennies. Okay. So from 30 to 65, homie's going to be dropping $417 into a Roth IRA. Tax-free money, right? So he opened it with 417 and he's going to put in 417 a month, and we're going to assume a 9% rate of return. Hell, Logan, I'll give him 8, right? I'll be extra conservative. Okay. I still win. How about 7? I still win. How about 6? I still win. How about 5? Guys, I could open him a bond fund and get 5% every year. I still win. How old is he going to be when he has 500 grand in his life insurance whole life cash value policy? Actual cash. How old is he going to be? Put it in the chat. Tell me. Tell me, tell me, tell me. 100. Guys, I have seen cash value policies. I have one somewhere where the client didn't reach maturity, right? They didn't win like the age lottery in the policy until 120. I don't even know how it was freaking legal. They ain't making it. They are not making it, right? Now, here's why I wanted you to remember the age of 65, where they stop paying on the life insurance policy. Okay. I'm going to go back to a more reasonable rate of return because look down here. This is the return your investment will generate over time. Historically, the 30-year return of the S&P 500 has roughly been 10 to 12%. Okay, so I'm going to go back to 9. Actually, you know what? I'm just going to go to 8. 8 is wicked conservative. No, I'm not from Boston, right? But I felt like just throwing a wicked in there just to make it fun. Okay. So 30 to 65, 963. I'll say 960. Because remember, he stopped paying, right? He stopped paying 960K. 1, 2, 3. Okay. I wish it would give me some commas, but it doesn't. He's 65 now. He's going to live to 100 because we have to compare it to the other thing. Oh, by the way, he's not going to put in any more money. Stopped. 0. And, right, I'm a good advisor, so we're actually going to shift him into something that's a little more conservative so that we can conserve principal. 5%. Guys, that's a bond fund. Bonds. Watch this. Drum roll. Listen, there is no scenario where someone that needs life insurance And I'm talking actually like income protection, income replacement, where putting it into a cash value policy will ever, ever beat what I just showed you. Guys, I'll put it into a freaking money market account and let it rip at 3% and I still win. Mr. and Mrs. Client, would you rather have multi-millions or 500,000 at 100? Guys, there's no scenario where you can lose. If you understand this and if you understand how the policies are structured, you can't lose. And you do not have to be investment licensed to use this calculator. It's just an illustration. Did I ever talk about a single actual investment? Did I name it? No. Right. So if I'm not naming it, I'm not advising, I'm just saying in general, this is how these things work. We would generally put you into a term life insurance policy that's level, where the price today is the price at the end. It's never going to change on you. We would put you into a Roth IRA so that your money's tax free, right? Because, oh, by the way, guys, if you decided, right, if you decided to take this money out, you could go cash this in like Scrooge McDuck and swim around in your basement on gold coins. It's all yours. The IRS doesn't get any. It's your money. It's your money, right? This is powerful stuff, guys. Because look, just the simple thing of going back to like 5%, look at the difference 2% makes. It's insane. And it has less to do with the percentage than what the underlying percentages do in terms of doubling periods. Okay. So let's talk rule of 72 really quick, because this is just some stuff you need to know, right? This is some stuff you need to know. Whoop, wrong way, wrong way. Here we go. Back up, back up, back up. One more, one more, one more. All right. And now everybody, you guys all have access to this document. This is not some special document, right? This is the one I built, right? This, you cannot find this on POL, but I took POL information and I put it into one place. Okay. So rule of 72, right? For our noobs that have never sat through this discussion before, the rule of 72, guys, is just math. 72 divided by the interest rate that you think your money is going to receive is how long it is going to take it to double. Okay. So if you're ever showing this to somebody, you can just say, hey, Mr. and Mrs. Client, this is just an example. It's just math. This is not, I'm not offering any sort of actual investment. I just want you to understand how compounding works. Is that okay? Is that fair? Get a yes, right? Get a yes. So check it out, Nicole. You wanted to know this 30 years ago. How old are your kids? How old were you 30 years ago? 19? 25? Right? But how old are your kids right now? Put in the Zoom chat, please, Miss Nicole. Because, guys, this is an important point, right? You will have clients that go, oh my God, I wish I knew this 30 years ago, right? 28, 26. Nicole, if I had met you when you were 26, 23, 28, do you think I could have changed your life? Do you think you'd be in a different position? Great. Why have I not sat in front of your kids yet? Your kids are that 30-year time machine that you wish you could get in. Why haven't I gotten in front of them yet? Put them on my calendar, right? This is the important stuff we got to teach people, guys. All right, back to the lesson. Whoop, back to the lesson. All right. Hey, listen, guys, I know you don't really want to sit down, but if I could show you something in an hour that could make you a multimillionaire later in life, wouldn't you at least want to know? Listen, I know you don't care, but how about you just sit through an hour with Noah and then you tell me afterwards if you don't care or not? Do you care about generational wealth for your children? Do you care about changing this cycle of month to month, right? Paycheck to paycheck? Do you care about changing that for your kids? Do you want to change something generationally for your family? Those are hard questions to say no to. And if you tell me no to that, we probably need to have like a deeper discussion. Right? No, I'm good. I love being broke. Hell yeah, stay broke. What? Nobody's gonna say yes to that, right? All right, back to the rule of 72. 72 divide by the interest rate that you think the money's gonna get is how long it takes it to double. All right? 72 divide by 3%, 24 years. All right? So Logan, we're gonna open three accounts and we're gonna slap 10 grand, bop, 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 into each one. 72 divided by 3 is 24 years, right? 10 grand turns into 20 at 3%, 24 years later. Think about this as your like a certificate of deposit at a bank, right? So a CD at a bank giving you roughly 3%, right? It's so low because it's guaranteed. There's no risk. Okay. This is also like a money market account right now, right? Nice thing about a money market account though is you can put it in, you can take it out. Put it in, take it out. There's no penalty, there's no fees, there's no nothing, right? 6% is sort of like a pretty conservative bond fund, right? So something for relatively conservative. Uh, at 6%, your money's gonna double every 12 years. Okay. 48 years later, you're not really gonna retire off of either one of these, right? But let's look at 12, right? 12%, your money doubles every 6 years. Now, listen, Mr. and Mrs. Client, there's nothing out there that's going to give you exactly 12% every year for 48 years straight. This is just an illustration. I want you to understand that. Is that okay? I don't ever want anybody walking away thinking, oh, Johnny told me he was going to give me 12% every year for 48 years, right? Yeah, see? No, that is not what I want you walking away thinking, right? I'm killing Trey Lynn over there. She's dying. This is good. This is good. I always know when I got a good one because Trey Lynn like falls off the screen and I got her, right? So that's, I'm, oh, she's dead. Oh, she's dead. But look, somewhere between 6 and 12, guys, is where your returns are going to be on average in the market. Okay. And this is the only place you can get it, right? So look, even at 9%, right? If you needed to like actually know, right? It's like 72 divided by 9, guys, right? 8 years. Every 8 years at 9%, your money doubles. Okay. So this is just an illustration, but nobody ever asks me usually, guys, like what it takes. They just say, okay, look, I just need to get here. How do I get here? Say, well, it takes time. The sooner you start, the better, right? The longer we
That's it.
wait, the harder it's going to be, right? Sean, I'm gonna meet you, right? I got you, girl. I love you, don't worry, right? But the one thing I can't replicate is time, right? If you come to me at 60, well, you generally are not going to have 48 years. If you leave it to a beneficiary and you're not going to touch the money, yeah, you can, right? You're just delaying that start time. Okay, maybe, right? But if you come to me like right now, that's hard one, right? So this is pure time. But the other thing you got to remember, this is just 10 grand and no extra money is ever added. All of the growth is from compounding. It's just from being in the market, right? It's pure growth. Okay. Pure growth in this scenario. If you need like going back to all of the like buy term and invest, right? If you are ever like, oh man, I can't remember that. Cool, Primerica can build it for you. You don't have to, right? It's simple. It's right here. Look, you have fake clients, right? You have fake clients. John and Mary, they had 200 grand in coverage each. They were paying less than 400 a month, even though they had 400 in coverage. Why? Because you got to marry, right? Women are always going to be cheaper than men at a standard rating, right? They live longer, they make better decisions. Logan, they're going to live long. They're less risky, okay? We are the dumber of the two sexes just generally, right? We do risky stuff, right? I've never seen a female version of the movie Jackass. Have you? Because they wouldn't do it, right? Because they wouldn't do it. Okay. So 315 bucks a month is what they're spending, right? We're going to switch them. Now, this is a little bit older, right? This is a little bit older. And so this is back when 400K was like the number. Now it's 500, right? Inflation, right? So 113 bucks a month is what this was costing them, right? And we're saving them 200 a month. So now we're going to buy term, we're going to double their coverage, and we're going to invest the difference. It's the exact same money they were already spending. We're not asking them to do anything extra, right? Don't let anybody ever come at you, Logan, and say, "Oh man, you're doing too much." Like, no, man, you're spending the same money. You want to get more for your money, right? Because watch what happens. And if you want to read the fine print, right? Let's look at the fine print. right? Because everybody always goes, oh, well, like you took some like crazy stuff, right? Like you did like like really good policies for them or something like no, no, look, right? Want. They're 35, standard policy, right? Here it is. Okay. Primerica monthly premium for 30-year Primerica precision term policy. Class 6 for the husband, standard. Precision term policy, class 4 for the wife, standard. They're both 35. Okay. Accumulation figure assumes a 9% nominal rate of return. There you go. 9%. Pretty conservative. Same number I use. Right. So there's nothing crazy in here. They didn't have to get like a 20% rate of return and they got some like crazy special class of coverage. Right. They're not preferred plus. They're nothing. They're just standard. Right. So even under like this is going to help you be a better agent, a better advisor because you know that these numbers are built on basics. Nobody got anything special here, right? They didn't pull any like crazy tricks to try to get these numbers to work. So now a 30-year term, 30 years later, the client's 65, they've got almost 400 grand in a Roth IRA. When would they have 400 grand in this scenario in cash that they could have without a loan? They'd have to wait 35 more years. They'd be 100, right? They'd be 100, guys. And let's just say, oh, well, I don't really plan to take that money because that's usually one of the things like, oh, I don't plan to take a loan on that. I'm gonna end up leaving that, right? Well, God bless. That's even worse. Because if you're not planning on taking the loan, your money is just going down a hole. If you're not planning to like borrow against it, well, it's just going down a hole, right? And oh, by the way, remember, you got to be 100 before the numbers equal each other. Well, hell, I got you almost to that same number 35 years early. Just saying. If you were going to wait till age 100 and I put that 400 grand in something for another 35 years, let's go back to the rule of 72, guys, right? Let's go back here and let's just see. Man, this thing is it's dying. It's killing me. I don't know why this little stupid guy won't go away. There we go. It just doesn't want to move anymore. I think my PDF is frozen. Hang on. All right, we're back. We're back. Give me another 35 years. How many more doubling periods can I get in 35 years? At 9%, it's every eight, right? So what, 4.5 more doubling periods? Call it 400, 800, 1.6, 3.2 roughly. This is how you can start to do some like quick, fast, like I call it beer math in your brain, right? We'll just say 370,000. I'm going to show you, right? It's going to be just a little under 3 million. We're not putting anything in and it's going to keep getting 9%. Oh, my bad. Whoops. My bad. You only got 8.5 million. If we weren't worried about it and we were just going to leave it anyway, well, hell, let it ride. Put it on black. See what happens. For a second, I thought I had too many zeros over there. No, that's 370,000, right? I'm going to retype it just to make sure I didn't fat finger something. 370, 1, 2, 3. 35 years, 9%. There you go. Whew. I missed a doubling period in my brain, right? I skipped one. I stopped you at like 3 point something. I missed one. Crazy, crazy. But that's also why you should never just do the beer math with clients, right? You should always show them because people believe what they hear, but they really believe what they see. Fact, right? Fact. All right, guys. Listen, I hope you enjoyed that tonight. I hope that was new for a lot of you, right? So most of you guys have never seen that before. That's the power of what you have, though. And listen, you don't have to be investment licensed to walk someone through a compound interest calculator. Go play with it. Go see what happens, right? Just play around, right? You get comfortable talking about the numbers. You don't have to be good at math. I promise you. Nothing that I did tonight was complicated. I've just done it a lot. There's no math. There's no math really. Like all the math is in here. You just have to understand how the numbers work together more than anything. And you have to get really, really good at telling a story. That's really where sales become real, right? And remember, I don't want you selling anything, deal, but I want you to be very good at sales. You need to understand the psychology of a sale, but you have to be comfortable getting in front of someone and showing them what you do, showing them what we do. Putting someone in front of a trainer, putting someone in front of a investment specialist, whatever, right? That's how you're going to get trained. You will learn more in a 1 hour appointment like this in the field with a client, letting someone else run it, and you showing up like this, shut up, smile and nod, take notes. That's your job, right? When you're new and you're getting your license or you're newly licensed and you still are not like, I need some training wheels. Cool. Bring me. Bring your trainer. We are the training wheels, right? We'll let you go until the point where you kind of like get that vapor lock and you need to phone a friend and we're right there. But the only way you're going to get good at it at some point is to start using your own mouth, right? Like we say to kids, right? Use your words. You have to use your words. You like I can say it all day long and it seems easy because I've done it thousands of times, literally thousands of times, right? And so you just have to get comfortable getting out there and doing it, guys, right? Kurt, man, I want to give you some praise publicly. You're doing a great job. You're talking to people, you're getting in front of people, you're getting them on the calendar, right? That's what it takes, guys. You you have to be okay with some no and just talking to lots and lots and lots of people. I'm going to leave you with one example, and then I'm going to let you go, and we're going to end a few minutes early because I have a 9 o'clock and maybe a 10. It's one of those days. If you take a deck of cards, how many cards are in a deck? Standard deck. 52, yeah? And two jokers. You're going to run into some jokers, I promise you, right? Logan,
Easily.
Can you take an ace, right? Or can you take a two and have it be an ace without it being a wild card, right? Can that card become another card? Can't, right? So if you've got a deck of 52, you've got four aces inside, right? You're going to have to go through the deck to get to your aces. And what I mean by that is it's going to take you getting in front of a bunch of people to show them what we're doing before you find somebody that it clicks for, that this makes sense to, and they're like, hell yeah, man, like I see it, right? A bunch of those people along the way, right? They might be king, queen, jack, might be some tens, right? But a lot of them are going to be like nines and under. And that's okay because it takes all kinds, right? You have to be okay with the fact that people are going to come in and out of your business, but they're there for a reason, a season, or a lifetime. And you just have to be okay with meeting people where they are and being able to just sort of bless and release and realize that it's not personal. There's nothing personal, right? If all of you guys quit on me today, I would be sad, but I would go get more. And I would meet you right where you are, and I would say, "Hey, I'll be here when you come back." And that's okay, right? And that's life. There's only a couple of people here right now that were here 2 years ago, a year and a half ago, right? Over a year and a half ago. There's like Trey Lynn and Angela, and that's okay, right? And that's okay. Yeah, Matt, you're like right over here. But oh, huge, huge public praise for Matt, right? Passed his SIE 663. And I think we were like you did all of that, Matt, in from when you got serious again and took your SIE to your 63, like 45 days, maybe from SIE 663. You should go back and look at that and see what the time frame was. And because I know we had a little bit of delay on your U4, but yeah, 8 weeks, right? 8 weeks, guys, from the time he took his SIE 663. He's fully investment licensed, right? We're waiting on everything to finalize and get back into the system. That's huge. Matt, we got to go write you at least $1,000 in securities trade so that you can get $1,000 bonus. Okay. As soon as you get licensed, dude, the bonus is still out there. We got to go write it. We got to go write it. We'll work on that together. We'll work on that together. All right, guys, get out of here. Listen, if you saw value tonight, right, and this was good for you and you got something out of this, do me a favor, go into Telegram and just write something, right? Tell me what you learned, right? And please start using Telegram more. That's our digital office. But when it's not just for like me to put stuff in or Angela, right? Like it's for everybody. If you have questions, ask them in there because I promise you, especially if you're new, somebody else has probably got the same question. And if you ask it publicly, it gets answered publicly. Okay. And that's just it makes the business more fun. I promise you, right? I promise you. Last thing I'll leave you with, right? East Coast Builder School. If you haven't got a ticket yet, or if you have no idea what that is, right? Text your trainer and let's get you a ticket. I think I have 11 left at like the flat 20 bucks. Okay. So let's get those going. Because even if you can't make it down here in September, you'll still get the Zoom for all of it, and it's cheaper than what you can get it for right now. All right, guys. I gotta go. I'll talk to you soon. Go write something in Telegram. Let them know what you learned. Let them know what you learned. All right. Bye, guys.